Hey guys, Britt here. Welcome to End Times Bible Prophecy. Make sure to hit the subscribe, like, share, and restack buttons. Well, did they just signal the beginning of the end? Now, what am I talking about? I'm referring to last week's Federal Reserve meeting where they announced a 50 basis point or 0.5% cut in the Fed funds rate. Of course, the financial media celebrates this as this is going to be great for the economy. But historically, it is not. And we're going to look at why this is actually things that are signaling recession, depression right now. We've looked at plenty of that. But why this cut in particular is signaling the end of something much bigger. The end of the global monetary system as it's been constructed since 1971. It's the end of this fiat monetary system. And it will be replaced by something else that I believe will eventually be the mark of the beast system. But there's several steps between where we are today and when we get to that system. So let's start by looking at this right here. So this is a tweet from Luke Groman. He says, what does the Fed see that made them cut 50 basis points now and claim they're going to cut another 0.5 point by year end? So many people say, well, why are they cutting? The stock market's near all-time highs. There's no problem with unemployment. Everybody claims the economy is good, although you and I know better. So what do they see? So this is his thought. He says, it isn't the pace at which the economy is weakening. It's that if you can't cut entitlements, meaning you can't cut Social Security and Medicare and Medicaid, and you won't cut defense, the only thing big enough to matter left to cut is rates aggressively. What he means is, given the size of the national debt and its percentage of the economy, well, really, the U.S. government has no choice but, well, they do have a choice. They have two choices. Either they can default on that debt, just say, you know what, we can't pay this. We can never pay this back, so we won't. Or they can pay that debt back with devalued dollars by printing more dollars into existence, conjuring more dollars into existence, and inflating away the debt, which of course is not a good thing if you hold dollars, if you hold U.S. debt. So that's what he's saying, is this is a signal that they can't sustain rates at where they're at now because of the interest expense on the national debt. We just talked about that last week. Over $1 trillion annually now, expected to be $1.6 trillion by the end of the year. That's unsustainable, especially when we go into a clear economic downturn where you can see unemployment spike, the stock market crashes, they're no longer taking in the capital gains taxes from the market that they have been. Then you see massive deficits of $4, $5, $6, $7, $8 trillion in a single year. That's where we're headed in the very near future. But in order to have any chance of not defaulting on the debt directly by saying we aren't going to pay our obligations, they have to inflate it away, which is a form of default. But they can claim, well, we didn't default on it. We told you we'd pay you in dollars, and we did. And you might go, well, it costs $500 to buy a loaf of bread now. But we promised, our promise was to pay you back in dollars, is what they'll say. So that leads us to this article here from Daniel Lacow. He says, an unprecedented monetary destruction is coming. He says, global money supply has soared by $20.6 trillion since 2019, according to Bloomberg. Additionally, global debt surged by over $15 trillion last year, reaching a new record high of $313 trillion. Around 55% of this rise came from developed economies, mainly the United States, France, and Germany. unfunded liabilities in the United States. So that means future Social Security payout obligations, future amounts that are obligated to be paid out, amount to $72 trillion, almost 300% of GDP. This may seem high until you look at Spain with 500%, France with close to 400%, or Germany with close to 350% of GDP. There is no escape from debt. Paying for the government's fictitious promises in paper currency will result in a constantly depreciating currency, thereby impoverishing those who earn a wage or have savings. Inflation is the hidden tax, and it's very convenient for governments because they always blame shops or businesses and present themselves as the solution by printing even more. Right? What have we said on this channel when everything goes terrible and so many people have lost their jobs, people are unable to afford their mortgage, unable to afford groceries? They'll say, well, we'll send you a special rent mortgage stimulus check every month. We'll send you a special grocery store food check every month. And then when that drives inflation higher, they'll say, well, now we need to double the amount of stimulus checks we're sending because rent and food are so outrageous. And ultimately, that just completely destroys the currency involved. He says governments want more inflation to reduce the impact of the enormous debt and unfunded liabilities in real terms. They know they can't tax you more, so they will tax you indirectly by destroying the purchasing power of the currency they issue. If you thought the monetary destruction we have witnessed in recent years was excessive, just wait for the suffering we will endure in the future. Meaning, if you think inflation's been bad so far, wait until what's coming. Now, I've mentioned in the past that hyperinflation is coming, but it isn't coming in the immediate term. In the immediate term, we're seeing deflation. That's what we're seeing in China. China is locked in a deflationary spiral. We're seeing it in Germany. We're seeing it beginning here in the United States. We're going to go into a deflationary spiral, a depression equal to or worse in severity to the Great Depression. That will be what launches this printing of currency all over the globe and ultimately destroys the fiat monetary system and devalues all of these national currencies. So he goes on. So that's, sometime out in the future, 2 to 4 years or more. I don't know. But right now, the threat is deflation. So he says the trillions of dollars accumulated in debt will lead to an unprecedented wave of central bank easing, which will continue to include negative real rates and even direct debt monetization. That means the government can't pay its debt. In order to keep the interest rates from that becoming so high, let's say $2, $3, $4, $5 trillion a year in interest on the U.S. national debt, the Federal Reserve will simply create dollars and use those to buy the debt that exists to try to suppress interest rates. That's what Japan has been doing for many years. They've come to the end of the road, as we'll talk about in a moment. The United States is following the same path. He says, however, they need an excuse to present themselves as the solution to the problem they created. A recession or significant slowdown will be the trigger to implement the plan to destroy the purchasing power of currencies. However, this time inflation is already evident and persistent. Fiat money is just a promise, and the issuer knows they cannot pay it in today's value. And what can't be paid won't be paid. He mentioned there needs to be a big downturn. There needs to be an excuse for all of this monetary expansion. In Saturday's video on the Substack on brittgillette.substack.com, we talked about how they may look to create the trigger for solely for the reason so that they could say, well, it wasn't our policies. Everything was going fine. Everything fell apart because of that war or because of that country's action. It happened because of these things. It wasn't our fault. That's what we've heard for the last 4 years with inflation. Well, it's not our fault. It's evil, greedy corporations. Not sure why those evil, greedy corporations weren't greedy prior to 4 years ago, when inflation wasn't the problem it's been the last 4 years. But we all know, because it's not the evil, greedy corporations. It wasn't Putin's fault, right? It wasn't the pandemic. It was the government response to the pandemic and handing out cash left and right, shutting down the economy. That was the problem. So guys, we're headed toward that economic downturn, that reason, he said, that they will have for the monetary expansion to try to prop up the system one last time. They won't be able to do it this time. We'll look at why in just a moment. But they're going to try, but we've reached that moment where we're going to see this burst into the headlines through crashing stock markets and rising unemployment. I mean, a big spike in unemployment. So let's look at why. We mentioned in the past this 2-year, 10-year spread. This is called the yield curve. We can look back at this back in 2022 went negative. That's called an inverted yield curve. And we've been saying for 2 years, when this goes positive and stays positive for a few weeks, that's when we know we're at that point where everything's going to start breaking and falling apart, and all of this will come into the headlines and become common knowledge. Well, this went positive at the close on September 6th. It's remained 11 straight sessions where it's been positive. It's actually been rising some more. So you can see, so I would expect if we see this maintain a positive level this week, that confirms the belief that this is the moment where we're going to see all of this happening. Let's take a look at this as well. This is from Federal Reserve Bank of St. Louis. This is net saving as a percentage of gross national income. So what percentage of people's income are they able to save? This data goes back to 1947. We can see here it's only been negative 3 times since 1947. The first was the Great Recession, which we see right here. The second was the pandemic shutdowns in the second quarter of 2020, and right now. So if you look at this graph, the Great Recession, we had 10 consecutive quarters where this number was negative. We only had 1 for the pandemic. Right now, we're at 6 consecutive quarters and counting. So 4 more quarters equals the Great Financial Crisis, the Great Recession. Guys, we're in the midst of this downturn right now. Again, we pointed out they often don't recognize recessions, depressions, economic downturns until 12 to 18 months after they began. And then they come out with some official reading. Oh yeah, guess what? The recession, the depression, it started way back there. And you go, yes, we know, we were all living it. We tried to tell you that. But you were locked in your ivory tower academic room, and you refuse to acknowledge that. But yes, we know that. So the downturn's already started, but we're getting very close to the phase where we're going to start to see breakdowns in markets and precipitous rise in unemployment that makes everyone come to acknowledge that and realize what we've been saying. So yes, like think of Wile E. Coyote running off the edge of the cliff and he's suspended in midair until he looks down. We're on the precipice of that look down moment, right? We're getting very close to it. And when that happens, all your neighbors will know what we've known for quite some time. So let's take a look at this. This is from, well, it's N0 Hedge, but it's actually from Brent Johnson. at Santiago Capital. This was I like the font on this one better than on his site, so we'll read it here. But we're just going to look at the executive summary because we've talked about the events of early August and the unraveling of the yen carry trade that led to the largest two-day crash in Japanese stock market history. That has not ended. We pointed out at the time that the financial crisis began. When they look back, they'll say it was probably around July, mid-July. That's when we saw a peak in a number of markets. We saw a peak in the Japanese, or a trough in the Japanese yen relative to the dollar. Since then, we've seen a reversal in those trends. We saw the Japanese yen carry trade unravel. Then everything got quiet and people said, oh, it's over. But it is not over. And this tells us one of the reasons why. So he says currency carry trades, while seemingly straightforward, carry significant risk due to their reliance on interest rate differentials between countries. So think of the difference between the Japanese interest rate at 0.25 and the US interest rate at 4.75 now. We've seen those contract. They were 0.1 and 5.25. So whether it's the United States lowering rates or Japan increasing rates, so we see those rates converge, the yen carry trade has to unravel. It no longer becomes viable. And you get margin calls, which is people who have taken out loans to speculate in the markets. They get a call, and that call says, give us more cash or we're selling your stuff to pay back the loan you took out. So that's often what leads to these crashing markets, is when you have margin calls. So it says, investors borrow in a low interest currency like the yen to invest in higher yielding assets. These trades are often unhedged, meaning there's no insurance taken out in case it goes the wrong way, and leveraged, meaning they're using borrowed money to try to make more, which works if it works out right. If it goes the opposite direction, you lose everything. It says magnifying potential profits, but also exposing investors to substantial risk, especially if interest rates or currency values shift unexpectedly, which again is what we've seen since July. The biggest risk is the implicit assumption that these differentials will remain stable, which rarely holds true over the long term. And that's, again, what we've seen since the middle of July. Despite the lessons learned from past failures, such as when the U.S. decoupled from the dollar from the gold standard in 1971, investors are often lured by the allure of stable, easy returns from carry trades. However, carry trades can appear benign for years before unraveling catastrophically, leading to sudden and severe market volatility. This was the case in the recent yen carry trade crisis of August 2024. The Bank of Japan now faces a dilemma, and we've talked about this before. This is an unavoidable dilemma. It says, do they protect the yen with higher interest rates or protect the Japanese government bond market with lower rates? They cannot do both. And I would say what they cannot do, they will not do. Meaning either Japanese government bonds become worthless, which has enormous repercussions. They're the fourth largest economy in the world. Or the Japanese yen becomes worthless. So either the currency or the government of Japan are doomed, right? That's what that means. And we're talking about the fourth largest economy in the world. So this has enormous repercussions for the entire global financial system. He says this is because the tools used to protect their currency conflict with the tools used to protect the bond market and vice versa. To protect a currency, a central bank will typically raise interest rates to make the currency more attractive to investors, which can help stabilize or increase its value. However, higher interest rates increase borrowing costs, leading to lower bond prices and rising yields, which can destabilize the bond market. This dynamic creates a policy dilemma, particularly in economies heavily reliant on debt, as higher yields can hurt economic growth and raise concerns about government debt sustainability. And I'll let you in on a secret. Japan's government debt is unsustainable. And so is the United States, right? And so are a number of other countries. It says, on the other hand, protecting the bond market requires central banks to keep interest rates low, which supports bond prices, keeps borrowing costs manageable for governments and businesses. However, lower interest rates tend to weaken a currency, making it less attractive to investors seeking higher returns. A weaker currency fuels inflation by increasing the cost of imports, particularly in energy-dependent economies, of which Japan is one. I believe over 90% of their fossil fuels are imported. So the majority of their energy to run their economy is imported in the form of fossil fuels. So central banks are thus caught in a balancing act where prioritizing one market often exacerbates risk in the other, making it difficult to maintain stability across both simultaneously. This is all happening at the same time the U.S. Federal Reserve is nearing a potential interest rate easing cycle. A potential interest rate easing cycle. And it's no longer potential. It happened last week. They started cutting, creating a squeeze on yen carry trade investors who face rate increases in Japan and potential rate cuts in the U.S. So we've talked about how that differential between the two rates, as it comes together and you no longer have that difference in rates, as it becomes smaller, as it compresses, you would have more unraveling of the yen carry trade, which is what led to the crashing markets in the beginning of August. It says one of the ironies associated with the recent volatility ascribed to the yen carry trade is that we have seen the same thing many times in the past. The 2008 global financial crisis offers a stark example of carry trade failure. At the time, yen carry trades funded investments and higher yielding assets worldwide. When risk aversion surged, investors unwound their positions, leading to a sharp yen appreciation and widespread losses. So the yen carry trade unraveling played a large role in the 2008-2009 financial crisis and the market crash we saw at that time. It says the yen carry trade crisis of August 2024 is likely far from over, with the Bank of Japan continuing to raise rates while global monetary policy diverges. The potential for further market disruptions remains high. As interest rate differentials shift between Japan and other economies, particularly the United States, central banks are left with limited policy options. Let me put it in simple terms. It's the end of the road. They can't kick the can down the road anymore because no matter what they choose, the result is the same. And we've talked about this before. It's a trap. No matter what they do, it's going to make it worse, not better. There's no simple solution here. It says the choice between protecting a nation's currency or its bond market becomes increasingly difficult, and the volatility in global financial markets may continue to escalate as a result. Investors and policymakers alike must understand the dynamics associated with carry trades, as the turbulence associated with them can strike out of nowhere. And there is nothing, let's underscore that, nothing to indicate these risks have been fully removed from the global landscape. Well, let me take it a step further and say they have not been removed from the global landscape. Guys, we're entering that time period, as I said, where everyone's going to know about all this because the markets are going to crash. And unfortunately, many people are going to lose their jobs. So let's cut over to justdario.com. This is from last week, the day the Fed cut rates. He says, Fed action today marks the beginning of the end of the fiat monetary system experiment. And the reason we've been talking about all of these financial issues, again, is because of precisely this. This is the end of a system that's been in place for many decades. And we have never had a time period in all of human history when every national currency was a fiat currency. That's something that's only been the case since 1971. Prior to 1971, if you had hyperinflation somewhere like Weimar Germany where the currency collapsed, well, you could get the British pound or the US dollar. They were backed by gold. There were other countries you could flee to. Even if you stayed in your country, you could trade in their currency and it held its value. If all currencies are collapsing, what do you do at that point? It's going to lead to a whole crash of the system. So let's see what he says here. He says the Fed is signaling the end of the financial system cannot sustain. I'm sorry. The Fed is signaling that the financial system cannot sustain the current rate levels anymore, which is really sad because Fed had only raised rates to 5.25%, and that used to be considered low. Probably 25, 30 years ago, people would have said, wow, what a low rate. That's great. Certainly 40 years ago when you had 17% interest rates, people would say, wow, 5.25%, that's great. Now 5.25% is so dramatically high, it's going to crush everything. That's how far they've brought us down to the end of the road with pushing off this crisis, pushing it off. All the cumulative total of all these decades of bad decisions are finally coming home to roost. Unfortunately, right here in our day and time. So it says, but wary of the reaction and quick escalations that unfolded in the banking crisis last year, this time around they are very careful in disclosing which financial institution is particularly in trouble. And they're out there, guys. We've talked about the troubles in the banking system, the U.S. banking system in particular, but it's a global issue. It says treasuries are warning very loudly about this, and it's only a matter of time before we see the events unfolding in this direction. The Fed isn't signaling the economy is strong by cutting rates, but the complete opposite. Every time the U.S. yield curve inverted, it always signaled troubles in the economy with a perfect track record, and this time isn't different despite their wanting people to believe so. And we just looked at that inverted yield curve. It's indicating we're at the end. So far, stocks are reacting positively because algorithms have been hardwired to do so, and the central bank has learned well to play around with them to control market directions. However, the more humans start to digest all I described above, the more they will start steering their portfolios toward a safer posture. The speed of this shift will be greatly influenced by the strength of the forced Japanese yen carry trade unwinding and the risk of triggering another disorderly sell-off, especially in Japan, if another big air pocket is hit in the short term. In the medium term, the financial institution currently in trouble will have a harder and harder time remaining out of the spotlight. When, like it happened to Credit Suisse, the name starts to make rounds on trading floors, another wave of selling in the market will unfold. And this will likely be stronger since coming on top of forced Japanese yen carry trade unwinding. In the long term, the Fed will have to deal with a significantly weakened economy and financial system that will likely scream for another system bailout. But will the Fed and the US government be able to provide that, given the current level of deficit and Fed balance sheet size compared to the past? I don't think so. This is why I believe today we are seeing the beginning of the end of the great fiat monetary system experiment that so obviously failed as similar attempts did before in history. Guys, every fiat currency in the history of the world has eventually gone to zero. That's a perfect track record. We have every reason to believe that the current fiat currencies are all going to go to zero. Whatever national currency you're using, whether it's the dollar, the yen, the pound, Canadian dollar, the euro, they're all going to be worthless at some point in the future. The system is unraveling. They know the system is coming to its end, and they're getting ready to replace it with something else. They're going to try to hold it off as long as they can, but at some point they know it crashes. Again, we talked in Saturday's video on the Substack about they may want to trigger the crash with an external event so that they can say it wasn't our fault, but we have the solution. And what will their solution be? We've talked about that in the past. Remember this article right here, how the current global financial crisis leads to biblical tyranny in 10 steps. This is from last month. And so far, everything is on schedule and following this outline, unfortunately. But again, we talked about the trap that Japan had. The Bank of Japan is trapped. That's what we just read about. They raise rates, they destroy their economy. They lower rates, they destroy their economy. There's no way out. They've reached the end of the road. We're going to see continued volatility. Debt will hit its limit. We're going to start seeing limited bank runs. So as Dario just mentioned, there's some financial institution out there they aren't revealing yet that's in a lot of trouble. All the indications in the background tell us that's the case. Once that name gets out there, there will be a run on that bank. But it'll be limited at first. It won't be a global banking system run simultaneously. It'll be a few banks here and there. Then we'll see the massive government bank, central bank response when they realize it's all falling apart. Then they'll make their mistake and follow the law. What a novel concept. Bail in a bank. And we've talked about what that is. If you don't know what a bank bail-in is, it means, well, you as a depositor are bailing out the bank. They're just taking your deposits so that they can remain in business. And then, of course, that'll lead to a massive global run on banks. Something big blows up. They shut down all the banks. Credit markets freeze. Global economy comes to a standstill. And then they roll out the new system. Hey, we've got the solution here. This will solve all the problems. Central bank digital currency, tokenized assets, digital IDs. These are the things that you need. And then they'll say, well, we know this was put out there for people to take advantage of. Now it's mandatory. No more cash. You have to be in the system. And then the system will be in place during the tribulation for the Antichrist to roll out the Mark of the Beast system. So guys, this is where this is all heading. This is why we talk about these things. This is, right now, this is very critical. The global financial system is a house of cards. It's a Ponzi scheme built on a house of cards, constructed on a foundation of lies. It's going to come crashing down. They're going to try to avoid the crash. It sounds strange. Why would they avoid the crash if they're going to roll this out? Well, right now, the people who are controlling this system have power. There's no guarantee, especially given what will happen when all this crashes, that they remain in power. So that's why they'll probably try to use an external event so that they can blame that. Oh, it's that war. this catastrophic war. I can't believe that world leader ABC XYZ was so irresponsible. And then they'll say, but we can solve the problem that person created by rolling out this new system. And then if the public accepts that, they remain in power, and they've got a new system, maybe lasts them, keeps them in power. So this is terrible stuff, but this is what's happening. It sets the stage for the tribulation period by putting a system in place that, again, is indistinguishable in function from the mark of the beast system. So that's why this is relevant if you study Bible prophecy. It tells us that we're getting close to the tribulation period. That time is drawing near. That means the second coming of Jesus at the end of that tribulation is also drawing near. And it means the rapture of the church is even closer, as I believe the Bible tells us that happens before the tribulation. So again, guys, a lot of this may sound like bad news, but it is not bad news, because it means Jesus is coming. And you know what? Jesus is fully in control. He's Lord yesterday, today, and he will be tomorrow. No matter what happens in this world, no matter what market crashes take place or bank runs or wars, no matter how bad things get here on earth, no matter how much we suffer, Jesus is still Lord. He achieved victory on the cross, victory over death. He paid the price. He paid the penalty for our sins. So guys, we have every reason to be filled with joy and hope, optimistic for the future, because Jesus is coming back. This tells us no matter what we have to endure here on earth, we're going to be with Jesus one day. So let me know what you think. Leave your comments below. Make sure to hit the like, share, subscribe, and restack buttons. And God willing, I will see you on Wednesday. Bye. If you want to learn more about the end times and Bible prophecy, make sure to visit my Substack at brittgillette.substack.com. There you'll find my latest videos and articles, as well as notes, where I share the latest news headlines, the articles I'm reading, and the videos I'm watching. Subscribe for free, and each new post on Substack will be sent directly to your email. Just scroll to the bottom of the homepage and hit the subscribe button. As an added bonus, your first welcome email will include a link to a copy of my free ebook, 7 Signs of the End Times. Also, make sure to check out all of my books. Just look up Britt Gillette on Amazon, Barnes & Noble, Apple iBooks, Google Books, Kobo, or anywhere books are sold. Thanks for watching today, and until next time, keep your eyes fixed on Jesus, the author and perfecter of our faith.